When should you sell stock? Welcome to Be a Baby Billionaire. Understanding the optimal timing to sell stocks is crucial for any investor seeking to maximize returns and manage risks effectively in the dynamic world of financial markets. While the decision to buy stocks garners significant attention, knowing when to sell is equally critical. It involves a nuanced assessment of various factors, from the health of individual companies and broader economic trends to personal financial goals and tax implications. By making well-informed decisions about selling stocks, investors can not only protect their invested capital, but also seize opportunities to redeploy funds into more promising investments. This proactive approach ensures that portfolios remain resilient and aligned with evolving market conditions, ultimately enhancing long-term financial stability and growth. 1. Deteriorating fundamentals. Recognizing when a company's financial health is declining is crucial for deciding when to sell its stock. Key indicators of deteriorating fundamentals include decreasing revenues, shrinking profit margins, increasing debt levels, and negative cash flow trends. If a company's financial statements reveal consistent weaknesses or if its competitive position in the market erodes, it may signal that the company is no longer a sound investment. Selling stocks under these conditions helps investors avoid further losses and reallocates capital to more stable opportunities. 2. Achieving investment goals. Selling stocks when they have reached your predefined investment targets or goals is a disciplined approach to investing. Setting clear objectives, such as a specific price target or percentage return, provides a roadmap for when to exit a position. Once these targets are achieved, it is wise to sell and realize the gains, rather than holding on in hopes of even higher returns, which can be risky. This strategy helps investors lock in profits and reduces the potential for emotional decision-making that can lead to suboptimal outcomes. 3. Market valuation. Evaluating when a stock has become overvalued based on valuation metrics is essential for making timely sell decisions. Key metrics such as price-to-earnings, P/E ratio, and price/earnings to growth help determine if a stock's price has risen above its intrinsic value. When these metrics indicate overvaluation compared to historical averages or industry peers, it may be prudent to sell the stock. Overvalued stocks are often susceptible to price corrections, so selling them can protect against potential declines and optimize investment returns. 4. Portfolio rebalancing. Selling stocks as part of a strategy to maintain a balanced and diversified portfolio is vital for risk management. Over time, certain stocks may outperform, causing an imbalance in the portfolio's asset allocation. Regularly reviewing and rebalancing the portfolio by selling overweight positions ensures that it remains aligned with the investor's risk tolerance and investment objectives. This practice helps mitigate risk, maintain diversification, and ensure that no single investment disproportionately affects the overall portfolio's performance. 5. Emergence of better opportunities. Divesting from current holdings to invest in more promising stocks is a proactive investment strategy. As markets evolve, new opportunities arise that may offer better growth potential or more attractive valuations than current investments. By staying informed about market trends and emerging industries, investors can identify these opportunities. Selling existing holdings to free up capital for these new investments allows investors to optimize their portfolios and enhance potential returns. 6. Negative earnings reports. Reacting to poor earnings reports that may indicate future underperformance is a crucial aspect of managing investment risk. When a company consistently fails to meet earnings expectations or experiences declining revenues and profits, it often suggests underlying challenges in its business operations or market conditions. Investors typically respond to such reports by selling their stocks to limit potential losses or reallocate capital to more promising opportunities. By acting swiftly based on negative earnings signals, Investors can mitigate risks associated with holding underperforming stocks and position themselves for better returns elsewhere in the market. 7. Industry decline. Exiting positions in industries facing long-term decline or disruption is a strategic move to safeguard investment capital. Industries can undergo significant transformations due to technological advancements, regulatory changes, or shifts in consumer preferences, leading to decreased profitability and market relevance for certain companies within those sectors. Recognizing early signs of industry decline and selling stocks in affected sectors allows investors to avoid prolonged downturns and redeploy funds into industries poised for growth. 8. Change in management. Selling stocks when a company undergoes a change in management and there's uncertainty about the new leadership is a prudent strategy for investors. Leadership changes can impact a company's strategic direction, corporate culture, and operational efficiency. If investors perceive that new leadership lacks experience, has conflicting goals with shareholders, or fails to inspire confidence, they may choose to sell their stocks to avoid potential negative consequences. By closely monitoring management transitions and assessing their potential impact on company performance, investors can make informed decisions to protect their investments and capitalize on more stable opportunities in the market. 9. Loss of competitive edge. Recognizing when a company is losing its market position or competitive advantage is essential for determining when to sell its stocks. Competitive advantages such as brand strength, technological leadership, or cost efficiency can diminish over time due to increased competition, changing consumer preferences, or disruptive innovations. When a company's market share declines, profit margins shrink, or customer loyalty weakens, it may indicate a loss of competitive edge. Selling stocks in such companies allows investors to avoid potential further declines in stock value and reallocate capital to firms with stronger market positions and growth prospects. 10. Personal financial needs. Selling stocks to meet personal financial requirements, such as major purchases or emergency expenses, is a practical reason to liquidate investments. Life events such as buying a house, funding education, or covering unexpected medical expenses may necessitate accessing funds tied up in stocks. Selling stocks for personal financial needs allows investors to secure liquidity quickly and efficiently. While it's important to consider potential tax implications and market conditions, meeting immediate financial obligations takes precedence in such situations. By planning and managing liquidity needs effectively, investors can maintain financial stability and continue to pursue long-term investment goals with confidence. 11. Tax considerations. Selling stocks for tax loss harvesting or to realize capital gains for tax planning purposes is a strategic approach used by investors to manage their tax liabilities. Tax loss harvesting involves selling losing investments to offset capital gains taxes on profitable investments, thereby reducing overall taxable income. Conversely, realizing capital gains by selling stocks that have appreciated allows investors to lock in profits and potentially benefit from lower long-term capital gains tax rates. By strategically timing stock sales to optimize tax outcomes, investors can enhance their after-tax returns and effectively manage their investment portfolios in accordance with tax laws and regulations. 12. Stop-loss orders. Utilizing stop-loss orders to sell stocks automatically when they fall to a certain price is a risk management technique employed by investors to limit potential losses. A stop-loss order is placed at a predetermined price below the current market price, triggering an automatic sell order if the stock price reaches that level. This strategy helps investors protect their capital by preventing significant losses in volatile or declining markets. While stop-loss orders do not guarantee a specific sell price in fast-moving markets, they offer a methodical strategy for giving up investments and reducing downside risk without needing continual supervision. 13. Market sentiment. Gauging when investor sentiment turns negative and might lead to further declines in stock prices is essential for making informed sell decisions. Investor sentiment reflects the overall mood of market participants and can influence stock prices independent of fundamental factors. Negative sentiment, driven by factors such as economic data releases, geopolitical tensions, or corporate scandals, can trigger selling pressure and drive stock prices lower. By monitoring sentiment indicators, sentiment surveys, and market sentiment indices like the Fear and Greed Index, investors can anticipate potential market downturns and adjust their portfolios accordingly. Selling stocks during periods of negative sentiment allows investors to avoid potential losses and capitalize on opportunities to reinvest at lower prices when sentiment improves. 14. End of a business cycle. Selling stocks as part of a strategy to exit positions before a predicted economic downturn is a proactive approach to managing investment risk. Business cycles typically consist of expansionary phases followed by contractions or recessions. During economic expansions, stock prices tend to rise as corporate profits and consumer spending increase. However, as economic indicators signal an impending downturn, such as slowing GDP growth or rising unemployment, selling stocks can protect capital from potential market declines. By recognizing the end of a business cycle and adjusting investment allocations accordingly. 15. Regulatory or legal issues. Divesting from companies facing significant regulatory or legal challenges that could impact their performance is a prudent risk management strategy for investors. Regulatory changes, legal disputes, or investigations can adversely affect a company's operations, financial health, and stock price. Uncertainty surrounding regulatory outcomes or legal settlements may lead investors to sell their holdings to avoid potential losses or reputational damage. By staying informed about regulatory developments and legal proceedings affecting companies and their portfolios, investors can assess the potential impact on stock prices and make timely sell decisions to protect their investments. 16. Strategic portfolio realignment. Selling stocks as part of a strategic realignment of investment objectives or sector preferences. This involves adjusting portfolio allocations based on changing economic conditions, market trends, or geopolitical developments that may favor certain sectors over others. Investors may sell stocks in sectors or regions expected to underperform and reallocate funds into sectors with stronger growth prospects or higher potential returns. 17. Lifestyle changes. Selling stocks due to significant life events or lifestyle changes that alter financial priorities. Examples include retirement planning, relocating, starting a business, or changes in family circumstances such as marriage, divorce, or inheritance. These events may necessitate selling stocks to achieve liquidity, rebalance financial priorities, or ensure financial security aligned with new life goals. 18. Summing up. In conclusion, the art of selling stocks requires a blend of strategic acumen, meticulous risk management, and unwavering commitment to financial objectives. Whether prompted by signals of deteriorating company fundamentals, shifts in market sentiment, or the need to fulfill personal financial obligations, timely decisions to sell can safeguard investments and position portfolios for sustained success. Time for the soft question. Under what circumstances and when would you need to sell your stocks? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.